Welcome to Taking Stock for the week ending the 9th of July 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, stream to you all things share market. Now, with the 2021 financial year over, our focus is on the full year reporting season, which will begin in less than 2 weeks. We expect it to be a strong one, with earnings growth of the market rising by close to 30%. And interestingly, this is also the return generated by the share market over the last financial year. As you can see, the chart on screen shows the earnings growth expectations at the GICS sector level, and the blue bar represents earnings growth for FY21, while the green bars represent growth for FY22. As you can see from this chart, the areas that are expected to post the strongest earnings growth comes from materials, which includes resources and building materials. And there's also strong growth coming into the consumer discretionary sector, which is not a surprise due to government stimulus and consumer spending during COVID. And of course, healthcare has benefited from higher demand for health products during the pandemic as well. On the other end, energy and oil and industrial stocks like mining services and those in transportation and roads, they expected to report muted growth. And stocks in this category include those such as Monadelphous, Brambles, and even ServiceStream.
Yeah, and importantly for growth investors, Kien, tech stocks have experienced a tough year with negative growth across some of our star stocks, such as Xero. But we do expect tech to regain its mantle in 2022, with the sector forecast to post the strongest growth for the year ahead. Meanwhile, stocks in the communication services sector, such as REA Group, car sales, and Telstra, are also expected to do well in the coming year. Note on the chart, earnings growth for the market is expected to slow down to single digits in FY22, and this is consistent with our view that the market has reached a peak in the recovery phase of the cycle.
Yeah, and usually we see a raft of negative company updates in the month preceding reporting season, but this period is often termed the confession season. But this year, there has been only a few downgrades as the economy recovers. In fact, over the last 3 months, we continue to see analyst upgrades come through, and the chart on screen shows this with the trend in earnings for FY21, and that's in yellow, and FY22, that's in light blue. As you can see, the yellow line represents the strongest period of earnings upgrades over the last 20 years.
Yeah, it's not surprising that the earnings strength has come from the cyclicals, financials like banks on the back of lower than expected bad debts, and resources following stronger commodity prices, especially iron ore. Star resources in this category include the likes of BHP, Rio Tinto, Fortescue, Oz Minerals, and Sandfire Resources. Meanwhile, this reporting season, the banks could potentially undertake share buybacks or increase dividends following the sale of non-core assets. For example, Commonwealth Bank recently sold its general insurance business to Hollard Group, while this week, Westpac announced the sale of its New Zealand life insurance business to Fidelity, which could lift its common equity tier 1 ratio by 9 basis points when the deal is completed in FY22, and the bank's current CET1 ratio is at around 12.34%. In addition, the recent strength in mortgage approvals data suggests upside to home lending rates, which in turn should support an increase in dividend for banks in the year ahead. However, within the bank sector, we are mindful of the risks with Westpac following its $200 million fraud discovery, which could be a small headwind to future reported earnings, depending on the outcome of recovery actions by the bank. For income-seeking investors, Westpac is currently trading on a forward gross dividend yield of 6.5%, and CBA is offering an attractive 4.9%.
Yes, and the reduction in bad debts will continue to support those dividends. But remember, for this reporting season, only Commonwealth reports, while the others have quarterly updates. Other sectors showing earnings strength heading to the reporting season lies in building materials on the back of government incentives on the housing construction and also low interest rates as well. And our star stock exposure here include James Hardie, Johns Lyng, and also Seven Group.
Yeah, and on the other end of the spectrum, earnings downgrades have been prevalent in consumer services, specifically in travel as well as food and beverages. Again, it's not too surprising here given the statewide lockdowns, the slow vaccine rollout, and the restrictions on international borders and trade. The stocks in this category include the likes of A2 Milk, Transurban, Horizon Holdings, and Sydney Airport.
Yeah, speaking about Sydney Airport, Jake, one of the key themes to emerge over the week has been this strength in M&A activity. Now, the company's unhealthy balance sheet, coupled with the lack of immediate cash flow, prevents us from investing in travel-related stocks like Sydney Airport. But the takeover proposal of this company at $8.25 per share indicates the appeal for high-quality infrastructure assets. This theme has also been reflected in the sale of this 49% stake in Telstra's mobile towers, and was the key reason for the positive share price sentiment for Telstra recently. Now, for income investors, Telstra intends to return about 50% of their net value to either through a share buyback or a special dividend announced at the full year result in August. Telstra is currently on an attractive gross dividend yield of just over 6%.
Yeah, and remaining on the topic of merger and acquisition deals, Macquarie Group made a move for AMP's global equities and fixed income business this week. Total cost for the acquisition is going to be up to $185 million, but the incremental lift to management fees will only be around $10 million per annum. Given the marginal contribution, we do not believe it will have a material impact to FY22 earnings, and as such, we have left our dividend assumptions unchanged, with the company currently on a gross forward dividend yield of 4%.
And on the takeover front, Rhipe received a binding cash offer of $2.50 per share from Norwegian cloud-based program reseller Kien Group. Remember, Rhipe is a reseller of cloud-based software products such as Microsoft Office 365. Now, this bid appears opportunistic, especially with earnings growth for Rhipe expected to be in the high digits for the next 2 years.
Yeah, and the deal does value Rhipe on a forward price to earnings multiple of 33 times. And although this does sound expensive, it is well below the historical valuation multiple. Shareholders will be able to vote on the offer in September, and given the current share price is trading at the offer price of $2.50, investors have two options. One is to hold on to their shares until the deal finalises and reap a potential franking credit of up to 6 cents per share, or sell at the current prices in case the deal does fall through.
And moving on from acquiree to acquirer, Star Income Stock Rural Funds, an Australian agricultural REIT, announced a 100 million equity raising for the development of its macadamia orchards, purchase of the water rights, and also additional cattle properties as well. The raising represents a 10% dilution to shareholders in the near term, but the key attraction here is the development of Rural Funds macadamia exposure, an industry which is well placed with growing consumer demand due to healthier diet choices. Now, in the near term, the water rights will underscore Rural Funds dividends as the company trades on a 4.7% yield in financial year 22. We do not believe the deal will have a negative impact on dividends, with management reaffirming distribution of 11 cents per share. That is well covered by financial year 22 operating cash flows of 12 cents per share.
Now, looking towards a copper miner, Sandfire Resources has received approval to begin mining operations at the Motheo copper project in Botswana. This is a significant development because Sandfire's main mine, De Grauza, has a limited mine life to the end of 2022, and the project should help the company's earnings growth profile, replacing some of the production from De Grauza in WA as that mine starts to wind down. Also, further upside from the miner could come from the expected completion of additional feasibility studies in the future.
Yeah, and we believe copper pricing remains buoyant on the back of the move to renewable energy generation and also electric vehicles as well. As such, we retain a positive disposition towards the stock.
Now, moving our attention towards the corporate calendar, we don't have any companies reporting next week, though AusNet will be hosting their AGM on the 15th of July, and Rio Tinto will be releasing its second quarter 21 production update on the 16th of July. And for those that are trend-sensitive investors, the stocks that turned bullish on the SD Max Stock Doctor moving average crossover during the week included car sales, while Evolution Mining, Newcrest Mining, Northern Star Resources, and Oz Minerals all turned bearish. On the SD30 TSR, both Medibank and Magellan Financial Group triggered a re-entry.
For Under the Microscope this week, we want to focus on star growth stock Collins Foods Group. Now, the company is one of the largest KFC franchisees in Australia and Europe, with approximately 300 restaurants across the globe. The company delivered a strong financial year 21 result with earnings per share growth up 21% over the period. But what prompted the market to sell down following the result, Jake?
Yeah, so we feel that the negative share price sentiment reflects the market's concerns that earnings momentum is on the wane. In the first 7 weeks of FY22, KFC Australia same-store sales were only up 2%, which is a significant slowdown, Kien, compared to the 13% that was achieved in financial year 21. Furthermore, inflationary pressures on chicken pricing and higher packaging costs could see earnings margins revert back to historic levels.
Yeah, so KFC Australia was a standout, and higher e-commerce sales were also a material contributor to the overall performance, accounting for over 14% of segment sales. Now, this helped offset some weakness in the KFC Europe segment, which was severely impacted by COVID restrictions and restaurant closures. But bear in mind, this segment only represents about 13% of total revenue. The other thing is Taco Bell now incurred a loss last period, but management remains positive on this brand. Why is that the case?
Well, Kien, Taco Bell arrived originally in Australia in 1981, but never really gained much traction until Collins Food received the rights to relaunch the brand in 2018. And although the segment was a loss maker last year, we do feel that consumer appetite for Mexican food has grown significantly in Australia. Sales have improved and store margins are on an upward trajectory. And once more stores are rolled out across the country, we are anticipating this segment to turn to a profit as soon as FY23.
Yeah, and the rollout of between 9 to 12 KFC restaurants in Australia prompts us to believe the current forecasts of a high single digit earnings growth is achievable. Hence, we believe share price weakness in this stock represents opportunity. As the reporting season approaches, we want to remind investors about the pitfalls of relying on valuation metrics in the current environment. Here at Lincoln Indicators, valuation is not a primary golden rule because it can be quite misleading. So the question this week is, why can valuation be unreliable, especially in the current market environment? Now, equity valuation is a topic we get asked quite often, and frankly, it is difficult to address as it involves a subjective process. It is extremely difficult to value a company because it involves the breakdown of assets, including intangibles, and predicting future earnings, cash flows, and interest rates. So the chart on screen compares the All Odds Index with the 12-month earnings expectations in black. As you can see, the first thing to note is that the earnings expectations have changed quite radically since the start of the calendar year.
Yeah, in fact, despite the share price rising strongly over the same period, valuation multiples such as price to earnings multiple was actually higher earlier in the year. A high price to earnings multiple would suggest that the market and stocks are expensive. And if you were influenced by this information, you would have refrained from being in the market during one of the biggest share market recoveries we have seen for some time.
Yeah, and in addition, when stocks are trading at a discount to valuation, it often implies that there are heightened risks attached to the stock, which could lead to further earnings downgrades and share price depreciation down the track. This is also true with income stocks that display a dividend yield that looks too good to be true. So, this concept is known as the value or yield trap and is often associated with the underperformance of value strategies. Hence, why valuation is not one of our primary golden rules.
Yeah, and the best way to try and use valuation is to understand why certain stocks trade at a premium or discount relative to the market. For example, among the banks, Commonwealth Bank has always traded a premium price to book or price to earnings multiple relative to its peers because of its dominant market position, a lower risk profile, strong capital position, and higher return on equity. And over the last 5 years, it has outperformed all the other banks, including the regionals.
And that's why we believe investors should be prepared to pay a premium for high quality businesses. Even Benjamin Graham, the founding father of investing, he observed that the greatest losses resulted not from buying quality at an excessive price, but from buying low quality stocks at cheap levels. And from our research, we also found that it's the trend in valuation and analyst price targets That's more useful in assessing stocks instead of looking at the absolute discount or premium to valuation. And members can do this on Stock Doctor by referring to Golden Rule 4, the share price chart, and clicking on valuations.
And Kien, as always, if you do need help understanding why our star stocks are trading at either a significant discount or premium to valuation, feel free to contact our research team and we will help you understand the risk so that you can make an informed decision.
That's right, Jake. By all means, don't blindly buy into a stock because it looks cheap. Thanks again, Jake, for your insights today.
Thank you for having me on again, Kien.
So with the reporting season fast approaching, it's important to re-evaluate your portfolio and be careful of buying or holding onto higher risk value stocks that could potentially fall further down the track. Instead of focusing on the discount to valuation, investors should use Stock Doctor to identify valuation trends when making an investment decision. Take care, everyone, and have a happy, healthy, and prosperous week.